we've got a deal on the west coast of Florida. It got hit by a hurricane. Like, how do you control that? Well, the answer is you don't. These are physical assets, and stuff happens. But I think communicating what's going on is absolutely key, and then communicating your plan to deal with whatever's going on is also an important key that I think separates an okay operator from an excellent operator.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Jerry Miller is making the move from full-time IT to now full-time commercial real estate investor. Jerry, welcome to the show.
Thanks, Sam. Glad to be here.
Absolutely, Jerry. The pleasure is mine. There are 3 questions I ask every guest who comes on the show. In 90 seconds or less, can you tell me, where did you start, where are you now, and how did you get there?
Okay, so I guess it was 18 years ago I got started in investing in single family homes. I've got a nice portfolio of single family homes. But 2 years ago, I invested as a limited partner in my first multifamily syndication. And I was very happy to get involved in that. Once I started digging in and trying to understand, well, if I'm making a 15% return, then what are the general partners making, and how is it that they're making such great returns? And once you begin to understand how to value a multifamily property, and what is it worth, what can it be refinanced for, you really do see where it's a better option to work on than, say, single family homes. And so since then I haven't really looked back. I've been doing commercial real estate as a general partner now. I'm on my 5th deal, and I'm very excited about the possibilities of commercial.
Wow, that's a lot of movement. And in there in your bio, you said you're making the move from full-time IT into full-time commercial real estate. So you're still in that transition period.
That's right, Sam. I've got my own consulting company. I'm kind of a one-man band. I do work in software consulting. I've enjoyed that. It's been a great living. I'm looking at, I'm coming up on 58 years old, and within a couple of years, I would expect to no longer consult at all, but exclusively do commercial real estate.
Got it. Now that's a lot. So you run your own consulting company. You are also, and you said you have 1 or 2 day jobs. I guess your consulting company is one day job, but you have another
That's
one.
right.
Oh,
Well, my real estate sometimes feels like a full-time job, right? Obviously, that needs to be as much nights and weekends as it needs to be, but occasionally it conflicts, where you've got day job type appointments. And so I just have to manage that. I do have a little bit of flexibility in my consulting job that I still need to just deliver at the end of the day. I need to make sure that, my client needs are met. And so if I'm not available at a specific time on a specific day, that's usually not a problem.
right, right. What would you say, or would you say that you've estimated the amount of time being a full-time real estate investor is required? Did you estimate that properly? Undershoot it, overshoot it? What do you think on that front?
Um, well, it's a great question, Sam, but the reality is there's the minimum of what you can do, but you don't come into real estate thinking minimum. You come in thinking, I want to cover all the bases. So you really do raise the bar. If you do estimate 10 hours and you realize, well, it's going to take double that, 20 hours a week to get this done, well, then you commit the time to get it done, because you can't do this halfway. You can't be questioning, is my valuation solid, is my asset strategy firing on all cylinders? You really have to bring your A game. And I would say that this is where, I think commercial real estate is a team sport. You need to be really clear on the roles and the responsibility within your team, so that you and your team members can carry that ball.
What have you done on the team front? I mean, getting into commercial real estate as a general partner, takes a lot of effort. But talk to me about team. What does that mean to you when you say that?
Good question. So I got started in commercial on the general partner side. One of the syndicators that I invested with was a limited partner. They were on the verge of potentially having to make a capital call. This was I guess it was the summer of 22, where the bank was requiring more seasoning, more reserve in the bank, and he had an investor that needed to back out. There was some personal thing going on, and I think most people know that syndications are illiquid. That's one of the potential weaknesses of a syndication. But this was a general partner that had a heart, and he wanted to be able to give that investor his money back. And so he had asked me, because we were on great terms. He was like, "Hey, do you have any more to put into this deal?" And at the time, I did not. But then he asked, well, do you know anybody that you think would be interested? And I said, well, I think I can call a few friends. We were only actually talking about a couple $100,000. And, I made like 10 calls and I raised $300,000 in like a week.
Hmm.
And I thought, wow, this was easy. It's not easy, but these were
Mhm.
close friends who I knew, had the money and had a serious interest in real estate. And I just needed to explain the syndication concept. And once I kind of walked through the risk and the reward profile, they're like, Jerry, this is absolutely something that I want to do. I'm not planning to retire for a while. So I'm good with this money, not being tied up in a deal for 3 to 5 years. And so that started me on a path where he was very pleased with my performance, and I was frankly very pleased with my performance. I wasn't thinking commercial real estate as a full-time gig at the time, but he and I chatted about, well, hey, we want to do bigger deals, and if you think you can continue to raise money like this, then we can do bigger deals together. And that was a turning point where I kind of set my mind on what will it take, to be a full-time commercial real estate guy. And the answer is, you need a set amount of passive income. I've already got a decent chunk of passive income from my rental property, so I just had to cover the remainder of meeting, my basic expenses. And so that definitely put me on a pretty serious path to spend time getting involved as a general partner. And honestly, I've really enjoyed it. It's been a lot of work, but it's been very rewarding.
Yeah, I would say so. I mean, that's one of those things that when you get into syndications as a general partner, you don't necessarily think that, hey, I'm going to have income coming in order to cover what I'm doing as a general partner, because it takes time to ramp up
Right.
your general partnership income side of things. So
Very true.
yeah, so that's an interesting point I think you've made there, is that there needs to be some residual income and or savings in order to cover that lean period of really growing your GP side of your business. I want to hear about this deal a little bit, because you mentioned the word, it was on the brink of a capital call and an investor needed money out. Talk to us about that deal. I mean, to me, that sounds like it has hair on it.
Well, that may be fair. So this was a pre-entitlement land deal. We were building 29 townhomes in Charlotte, North Carolina. It was an 18 to 24 month play where you put your money in. There was a nice return when they get entitlements, build the units, and then these all were going to be individual sales. So they've got to sell all 29, and then they were going to cash out the investors. Um, I don't necessarily recommend the land deals as a first deal for folks, getting involved in syndications. I would kind of recommend the multifamily value add where you're buying an existing apartment complex and you're going to execute an asset strategy to make money in probably a 3 to 5 year time period. I think they're a little safer. I think they're like the dividend versus growth stock. This analogy that I use with my investors. If we think about a growth stock, you don't get any dividend, but you have very high appreciation that you're hoping to get somewhere down the road. That's your land deals in the multifamily space. There's great upside potential, but there's risk that it's not going to go according to plan, and therefore you can't bank on any of that money. Versus your value add play, well, that's your dividend stock, right? It's very unlikely to have huge appreciation. What it's going to have is nice stable rents paid over a period of time, and over a long period of time you might get to enjoy a little bit of that growth from the net income increasing, but it's less likely to produce the same return as the raw land deal. So I think this was my third limited partner investment, and I knew the team well. I knew that they'd been doing pretty much all the things right, and so I was comfortable working with them to basically recruit friends into a deal that I was already in, and I was very upfront about that, and they were happy to be a part of that. So there was some risk that we did need to put more money in the bank, but that's not an all bad thing. That just means your reserves are higher than they were, and we didn't have to cash out this investor. Right on the dotted line, they've
Mm.
signed that they're illiquid, but we wanted to because again, we want people to do what they want with their money. So I actually liked the heart behind it. I don't want to work with somebody that's, kind of a, hey, that's too bad, right? I want to work with somebody that's like, hey, we just got to go the extra mile to find the investor to sort of buy out their position, which is exactly what we did. And everybody sort of got what they wanted out of that deal.
Right. Yeah, and that's a good point you're making there. I mean, and I don't know. I mean, I'm sure there are sponsors out there that would be, kind of hard nosed about it. Like, well, I'm sorry, you put your money in, go fly a kite. I think most of us would probably be like, yeah, all right, I get it. Like you want to cash out for whatever reason, and we'll work to try to find a way.
That's right.
And it may take a little time, but you can work. And let's talk about that. I mean, this show is called How to Scale Commercial Real Estate. You're getting into a nuance there that I think most of our listeners probably understand because it's a pretty high level show here. But just to tell us about that illiquid investment and what the options are that most investors have if they want to then get out of an illiquid investment. What are those options, generally speaking?
So it all depends on the contract that you signed with that general partner, right? Is it a JV? Is it a joint venture deal where you're part of a partnership and you have very clear, buyout arrangements where one of the other partners is potentially going to buy you out? Most of the syndication language is very much a once you put in your money, it's totally up to the operator when you're going to get cashed out. And it's typically going to look like a 3 to 5 year, either a refi or a sale of that asset.
Right.
um, it tends to not be in the limited partner's favor for the syndication because it kind of can't be. What you want to do is find a general partner team that kind of has a heart, that has the ability to raise capital on a regular basis. And, again, if you're getting started, then probably take that minimum investment. Don't overextend yourself to where you think you might need that money down the road, but take a more limited, lesser position. And then if you get excited about syndications and you want to do it again, then 6 months later, maybe do the same amount with the next investment. And that way you're sort of diversifying a little bit of your risk and you're understanding, what a good syndication deal looks like.
Right, right. And I think one of the things that we've seen, commonly see both in deals I've invested in and also our own in-house deals is that the sponsor or the general partner, if a limited partner needs out, generally has the first right or first refusal. So if you, Jerry, had invested with me and you came back to me 6 months later and said, "Hey Sam, I need my 100 grand back," I'd say, "All right, Jerry, well that's fine. I may want to buy you out personally and take over your limited partner position, right? Or you
Right.
could do just like you guys did and went out and found some other investors to then take your spot. I mean,
Exactly.
it's possible. It's possible. It's and you know what the bummer about that is I know it's never in because you got there's cost, there's fees associated with it, and it's a little bit of a paperwork trail. It's never in the LP's best interest to cash those out because it's like, well, at this point, you're probably going to get your money back, and that might be the end of it. And there might even be a little bit of a haircut just from associated fees that go along with, attorney's fees, et cetera, repapering stuff and trading all that stuff out. So it's, but at least it's an option. It's always an option there in your tool
That's right.
if
That's
an
right.
investor wants a
And
way out.
and the timing, of course, matters, right? We like to have, GP interest in every deal because we like to be able to say, hey, we're into every deal. But then three deals actually came along between about March of 22 and about June of 22. And so every one of us was sort of tapped out. We already had money in they were in different states, right? But the point is we had already kind of committed to that. So we weren't in a position at that particular time to
Right.
to, to buy them out. But
Right.
you're right. It's all dependent. I think honesty and transparency are just absolutely key in this industry. If you can't buy them out and you just straight up tell them what's going on and the why, and hey, 3 to 6 months from now, when I get my earnest money back from a deal that's going on right now, there may be that possibility. I think people understand when you're doing the best you can for them, even if they don't get the desired result. At least you're trying on their behalf to help them with whatever their situation is. And that's been key for me. I've had um you know we've got a deal on the west coast of Florida. It got hit by a hurricane. Like, how do you control that? Well, the answer is you don't. These are physical assets and stuff happens. But I think communicating what's going on is absolutely key, and then communicating your plan to deal with whatever's going on is also an important key that I think separates an okay operator from an excellent operator.
How do you vet or what things do you do differently now when you look at general partnership opportunities that maybe you didn't do on the first one?
Good question. Well, on the first one, I wasn't lead, so I would say I wasn't really the one making the shots. I was depending on the folks that had done this many times before, and my piece of it was, specific to capital raising and asset strategy on what I thought we could do and when. So I would say, a contributor in the early days, and now I'm stepping up as more of a lead. And I think the answer to your question is it, it being a team sport, you need to be very clear, what expertise am I bringing to the table? What expertise are my team member or members bringing to the table? And does that skill set cover all of the things that you think you're going to need?
Hmm.
That's a really important thing. If the deal I'm working on right now has a development component, and so one of my partners is a general contractor, and he's got a lot of experience on what is the price per door and what does it take to build things. And he's got a skill set that I don't have. I've got the underwriting side, I've got the asset management side, and so what's nice is we complement each other extremely well.
That's great. That's absolutely great. Let's talk a little bit. I mean, you've said you've been in real estate for 18 years. You made the leap to a limited partnership in
Mhm.
multifamily syndications 2 years ago, or maybe it was more than that, but maybe it was 2 years ago you did GP. I'm getting my notes mixed up here. But talk to me about the size of the deals and just kind of what velocity looks like for you compared to your first X number of years investing on your own in single family and now what you're doing commercially.
Great questions. So when I invested, um, when I got started, we took down I think it was a $10 million asset. Again, the syndicator was two guys that were seasoned, done this before. They were both full time in real estate. I had a good relationship with one of the principals because he and I had actually worked together in the consulting space. So I already knew that, he was a really solid guy. So it was a win-win for me to get started. And again, my role was much smaller. And so we did kind of the same thing for then a $20 million asset where we had to raise a little bit more. It was a little bit more involved in the reserves and the asset strategy, and that was a nice step up. I was involved in two different land deals that were pre-entitlement, and there's sort of a set of risks associated with, hey, we think we're going to build X number of units, but the reality is the permitting may not come back at what you plan for. And so, we chatted a little bit about what does it take to raise money for those, and it's transparency. It's, hey, here's the blue sky version of what we think is going to happen, and here's the what I call the Debbie Downer version, like this might actually happen. And so what I like to describe to my investors is, what does that cone of uncertainty look like, right? What is best case, what is worst case, and then what is most likely case, so that they can fully appreciate, you know, how much is their money at risk. Because the reality is, the pre-entitlement, your money is much more at risk. And people need to understand that that's why you get such a better return than the typical value adds. And it's up to you to decide, do you want to allocate, a portion of your nest egg in that, because again, you can make better returns, but you're at greater risk of principal loss.
Right, right. No, I think that's great. That's great. Yeah, I mean, so you've done quite a bit here in the last 2 years. You've been involved
Hmm.
in a variety of really unique assets and or yeah, unique assets and unique strategies. I think a lot of people aren't. I mean, it's a little more advanced doing entitlement and land and all that stuff. I think you said it early on that hey, you don't necessarily recommend that. But what would you say is a safe way for someone to get started in commercial real estate? Because it sounds like you went headlong, and maybe
Hmm.
there's other options out there that you'd say they're a little bit more on the well-beaten path.
I would say, for somebody that's brand new, get into a multifamily value add deal. So that's an existing apartment complex where the operator's got a plan, to grow the net income. That means they're probably driving rents up and they're probably driving expenses down, and then taking advantage of that increase in net income. I would say, as a limited partner, the one piece you probably need to educate yourself on is, how do banks and general partners evaluate the worth of an apartment complex? at the end of the day, it's all about that net income. But understanding how to get to that net income is an art. There is quite a lot of detail that goes into that. And so as the limited partner, you can just point blank ask, how are you going to drive, net income? What's the strategy? And, for somebody that's doing the underwriting model, they have to go line by line and understand, our property tax is going to increase by the cost of inflation, our rent's going to increase by, and just go through what that looks like. And then we typically do a 3 to 5 year forecast to see where do we see that this asset is going. And so that's a deep understanding for the general partner that the limited partner just needs to have a working understanding of how did they arrive at the numbers that they're at.
Right, right. That's awesome. Jerry, it has been so much fun having you on the show today. I've learned so much from you. It's been a blast to see your journey through the single family space, now into the commercial real estate space. You've gone headlong into it. You've certainly making some really great strides, and I love the information really you've brought to us today, both from how to get involved in it, things to look out for, ways to get started into it, what it's taken for you to scale, the amount of effort and work I think that goes into being a general partner. I mean, that's again something that we talked about that is often probably misestimated. So I just really appreciate you taking the time to come on today. If our listeners want to get in touch with you and learn more about you, what is the best way to do that?
Well, Sam, my website, www.largogroup2011.com. Yes, that was the year that I founded Largo Group. There, folks can hit me up on LinkedIn, Facebook, or Instagram. If you're interested in potentially looking at our next deals, go ahead and schedule a call. I need to get to know you a little bit and understand what your goals are. But really that website is the front door to reaching me, whatever folks want to do. I've always got the free ebook. You can, for getting started in real estate, you can just plug your email in there. If you want to just kind of sit back and watch, we'll send you some good content via email. It's really up to you what level of engagement you'd like to have.
Fantastic. Jerry, thank you again for your time today. I certainly appreciate it.
Thanks, Sam. Great to chat with you.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much and hope to catch you on the next episode.